Conventional wisdom says you should always buy instead of rent your home if you can. It's an asset that appreciates over time, whereas if you rent, you're paying for someone else's mortgage. So naturally, I wasted at least $350,000 renting in New York City in the last 10 years. Me, right? I just wanted to broadcast my idiotic life choices. That's the end of the video. I'm done. Stay curious, noobs, and don't follow my footsteps. You're still here? Let me see. About 35 seconds in. There's about 70% of you still watching. Let's get that down to 10% so my strategy doesn't go mainstream. Let me kill some time by explaining house hacking, since there aren't like 800,000 videos about it out there already. House hacking is a pretty creative shortcut to homeownership, where by renting out rooms or an ADU in the house that you live in, your tenants enable you to either get a larger home than you can normally afford, or you could pay down your mortgage faster. Well, I did something better than house hacking. You see, I actually could have bought a studio or a small one-bedroom for around $750,000 in the same building I was renting in 10 years ago, and I would have saved myself about $3,000 a month in rent or $36,000 a year. But the taxes and maintenance were $1,400 a month, which is about $170,000 over 10 years. And interest rates for mortgages back then were around 4 to 4.5%. So if I had taken out a $500,000 mortgage, I would have burned almost $200,000 in the interest portion of the payments in the first 10 years. And had I bought back then, the real gut punch would have come if I tried to sell this year, because the prices in that building today are almost exactly where they were 10 years ago. The pandemic cratered a lot of apartment prices to pre-recession levels, and a lot of them still haven't recovered. So yes, I rented, but I also bought my first property at the same time. I just didn't live in it. I chose to invest in a suburb where the cap rate was 7%. Remember cap rate? It's the NOI divided by property value. So this meant that my NOI was 7% of what I paid for the building. The NOI was a lot higher than the NYC apartment because the property taxes were much lower. And the maintenance didn't have to cover 24-hour doormen and all sorts of other staff. And the neighborhood wasn't as dense, so it didn't have an insane amount of people bidding on the property. And over time, my rental income grew to the point that now it covers my mortgage payment, my rent, and there's still quite a bit left over. The benefits don't stop there. I put it in an LLC, so my personal finances are shielded, and there's a lot more deductible expenses than if it were my own home. And also, it almost doubled in value, so I got to refinance and take out most of my original equity and then put it in other deals, effectively kickstarting my career in commercial real estate. And unlike in house hacking, I don't have to be roommates with my tenants. Now let's break it down. This strategy worked because I took advantage of the spread in cap rates. Most condos in NYC trade around a 3% cap rate, which is the lowest in the country, just ahead of other major cities like SF and the Bay Area, LA, Seattle, and Boston. The market perceives these areas to be relatively low risk with good appreciation potential, and it's full of competition from owner-occupiers who don't really care about the cash flows. And as you can see in my example, the market isn't always right about the appreciation potential. And I only rent where the cap rates are exceptionally bad for the landlord. I currently live in $1 million apartment with all sorts of fancy amenities and proximity to a subway, but my rent is $3,000 a month. My landlord has to pay $750 a month in taxes and maintenance, so they net $2,250 a month, meaning their cap rate is a miserable 2.7%. And now with interest rates rising, it makes even less sense for me to buy in a low cap rate building. So where are these high cap rate properties? Most suburbs and rural areas trade at relatively high cap rates compared to the cities they're close to. The further out you go from the city, the higher the cap rates tend to get. The asset class also plays a big factor, like if it's a hotel, industrial, retail, or office. The more property hunting you do in an area, the more of a feel you'll get for where each asset class sits on the cap rate spectrum. The important caveat is that cap rates are high where buyers think there's elevated risk. Like in less populated neighborhoods, there's a higher chance of vacancy because not as many tenants are out there. Whereas in New York City, you'll rarely have a day of vacancy aside from when you need to clean the unit between tenants. The cap rate reflects how the market has built the risk into the price. So if you want to find an extra good deal in a high cap neighborhood, you have to understand where the market is being a little bit irrational, which happens a lot, and understand whether you can minimize the risk that the rest of the market thinks is there. So you need to know the neighborhood well, and you need to understand how the target property is positioned to perform against the competition, and then see what you can do, if anything, to make it even more competitive. Now going back to my example, I knew the neighborhood I bought in really well because it was my hometown. And over time, I saw that as fancy rentals popped up at higher price points all over the area, my lower priced units became more scarce and more attractive. So my vacancy has been extremely low and my income has been a lot more stable than the cap rate would suggest. So the moral of the story is manage your risk properly and your cash flows will be healthy. Good luck property hunting and investing, and stay curious, noobs.